Hey, Nash Evans here at oilcashflow.com, and today I welcome you to the Morgantown multi-well joint venture. It is a two-well project consisting of the F.W. Buckley 33-6 and the Riles 1-33. We put this project together so we can rehabilitate two different wells and turn them into a monthly cash flow. In this video, we'll showcase and highlight each one of those pages of the project. Here on the introduction page, you're going to see a term highlighted throughout, and that term is partner. And I'm sure you're asking yourself, what's the difference between a partner and an investor? Well, an investor is an individual that puts money into something with hopes of a gain. Now, we hope to have a gain here as well, but being a partner, you get a lot more benefits. You're putting your money and risking your capital alongside ours in a proven field with proven reserves. You're also getting the tax benefit associated with that. And you're also being able to get in at a project a lot less than the cost to replicate. The one thing that I do ask of everybody looking at our project or this video, if you were considering investing 5+ units in this deal, please give us a call sooner rather than later. We want to make sure that we still reserve enough units for the individuals that cannot participate at that level. But from here, let's go into the deal and let's get into the geological assessment. Here you're going to see our Buckley well. The F.W. Buckley 33-6 was drilled in 1992. When it was drilled, it was originally completed in the upper James Lime sand. James Lime sand came in about 50 barrels of oil per day, and it eventually tapered off to the point that it was producing around 20 barrels of oil per day. In 2007, this well was re-perforated and recompleted in the lower James Lime. The lower James Lime initial production was around 150 barrels of oil per day. So when they decided to do that, they had to shut in the upper formation that was producing around 20 barrels of oil a day at the time to start to produce the formation that was doing around 150 barrels of oil per day. They started to produce the well, and over a period of time, I think it was around 2013, they started to see a decline fast in the production. Well, there was a couple mechanical issues that occurred downhole. We'll explain that here to you in a later page. But when they shut the well in 2013, it was still producing around 20 barrels of oil per day from the lower James Lime. Big picture, what we're doing here is we're going to repair the mechanical issue that is occurring inside the well bore. Then we will open up both formations. We're anticipating around 50 barrels of oil per day from both of them when they are both producing mechanically sound. This page here, we're talking about the Riles well. The Riles well was drilled in 2008 to the depth of a little more than 16,800 foot. This well was originally drilled to produce from the Austin formations, which is a predominantly gas saturated sand. In producing the sand over a period of years, the production started to decrease, and they utilized coil tubing inside our production tubing to increase their gas to surface. Over a period of years, the coil tubing got severed and got stuck inside the production tubing, and we will need to remove the production tubing along with the coil tubing and packer. We will be abandoning the bottom formations and will be completing in the same area of the James Lime sand that is in the other well that we just discussed. Next, we're going to talk about the financial projections page. Here you're going to see a unit is $150,000, and that is for 4% working interest in each well, for a total of 8% working interest. One of the biggest aspects to this are the tax benefits. If you receive around a 95% write-off for 2023, $150,000 position should save you around $50,000 in taxes. So that means your cost basis is not $150,000, it's around $100,000. And that means all I have to do is get you close to $100,000 to break even, and anything over and beyond that is profit from there on out. Now, how are we going to get your capital back and those profits? You're going to see two different formations here in the Buckley and one formation here in the Riles. With three formations producing mechanically sound, we estimate anywhere from 100 to 150 barrels of oil per day. And at a $75 to a $95 oil environment, you're looking anywhere from $6,000 to $12,000 a month income. Now, if you want to see your very specific tax scenario, please click here, check out our calculator, and you're able to enter in your own specific income, tax bracket, the write-off, what you anticipate oil production to be, and what you expect the price of oil to be as well. You can make your own adjustments to come up with your own estimated payout schedule. Here we have the wells page. You'll see the Buckley and the Riles. If you click on the name of each well, it will take you to a Google image where you can actually see the satellite imagery of where the wells are located and where they sit and how they look today. And directly underneath that, you're going to see the API number. The API number is very similar to our social security numbers or a VIN number on a car. That is the individual identification number for that asset. If you click on that blue number, it will take you to the Mississippi Oil and Gas Board website that directly links to this well, so you can see the previous production, you can see the documentation that has been filed, that we own and operate the well. So there's a lot of due diligence that can occur on this page alone. On this page here, same thing as the links that you clicked on with the well name, but this one takes you to Google Earth. You can see a 3D satellite image of this area, and you could kind of move around the field as well and see logistically how close these wells are from one another. Here we have the Morgantown field map, and what you'll see is a couple of the other wells that are drilled into the field, but the little box that you're going to see on this page is very crucial. Within that box is the two wells in this project and a third well that we'll be using as for an offset well to determine what we estimate our production to be in our wells. This page is the subsurface map. Anytime we're doing a project, the only way to estimate future performance is to track history. And this well really talks about the history of this area, but it's the three wells inside that square that we talked about on the previous page. And how big is this square and how close in proximity are these wells to one another? What you're going to see that mainly on this page, we're going to be talking about the Riles well. The Riles well is about 800 yards away from the Buckley well and about 1,200 yards away from the offset well, which is going to be our Forbes well here. What we're looking to do here in the Riles well is we are going to complete the well in a James Lime sand. So we're going to use the performance of two other wells that produce in the James Lime sand that again are 800 yards away, 1,200 yards away, so they're not that far. We're going to use their previous production histories to estimate what we believe our well can do in the future. Well, what you're going to see on the left-hand side here on the bottom is the James Lime well. So if you were to take that square on the prior page and turn it sideways and at an angle, this is like a cake view of what the formations would look like. So you have three different lobes within the James Lime, the upper, the mid, and the lower. Our objective here is to go back, remove the tubing and the coil string, relog the well, and analyze each one of those different zones, but their logs indicate that they have the capability to produce very similar production from the Buckley and the Forbes well. Well, the Buckley well from the upper lobe came in at 51 barrels a day. The Buckley from the lower lobe came in at 146 barrels of oil per day. Now, move to the Forbes, it came in at 251 barrels of oil per day. So we don't know exactly what could come in, but we know in a smaller, tighter section, they come in around 50. In a bigger section that has a little better porosity and permeability, it's 250. But that's why we believe 100 to 150 is a very feasible number if properly perforated in the James Lime sand.
So behind us we have E&D rig number 2. That's the same rig that we had on our Phoenix Minerals number 4 well, which is where we also had a stuck cap string. They did a really good job getting the cap string out, getting the tubing out, which is the same thing we'll be doing in this well. So we'll cut everything out, start fresh in the well bore. We'll go back in. Right now the zone's perforated in a Halston sand. We'll be moving up hole to a James Lime. The James Limes in the field have done anywhere from 50 to 250 barrels a day. We are expecting to do 100 plus due to where we sit structurally on the sand compared to the other wells. So once we get the well cleaned out, we'll go back in, set a packer, reperforate our new zone, and bring the well on.
All right, Justin, hey, thanks so much, sir. I appreciate it. As we're swab testing the Pittman B1, and then we'll be moving to the wells in East Morgantown. One of the greatest aspects of the East Morgantown field, I don't know how I forgot to say this, transportation. It's in a lowland in South Mississippi, very close to the Pearl River. Logistics are a lot of the hurdles that we have to deal with day to day. We actually own a 21-mile pipeline, correct?
That's right.
So that's the really good thing for our partners, is that we are able to transport your gas without having to pay a middle transportation company to have pipeline access. So one of the greatest parts of reworking these older wells is the infrastructure is already in place. We're not having to find it. We know what's there. Then we have to start putting in the engineering and the geology. But luckily, mechanically, and with our engineering guys in the field, we're able to be a couple steps ahead of other competitors when it comes to this work. Now for the Buckley well. Let's get into some of the mechanics. The Buckley well originally drilled and produced in the upper James Lime, then it was sealed off, then it was completed in lower James Lime and produced. Had some mechanical issues that slowed down the production drastically. This is where experience comes into play. My dad's drilled and completed over 650 wells. Alan Floyd that works with us has worked on over 1,000 wells, and he is, very knowledgeable about this area in Mississippi. But what occurred in this well when they were producing in that bottom formation is they utilized a gas lift. So they would put gas down the well, and it would come back up through the tubing, and the production would come in with the gas, and then they would separate the oil and sell the oil. Well, over a period of time, worked a hole into the casing, and that gas escaped through that hole. Well, the problem was the gas was not getting to where the oil was, so it was not helping the oil come to surface. Our job here is to identify where this leak is, repair the leak, get the well cleaned back up, go back in, open up both formations, and produce it via gas lift the same way that it was successfully producing before. Now you'll see another video associated with this one that explains why we've been pretty successful with this exact same work, given we literally did it a week ago. The Buckley well that we're going to be reworking is very similar to the work that we just performed here. So I'm going to have Justin explain a little bit about the work that we're doing here on the Pittman B1 well in Dexter and how it correlates to the work that we're going to be doing on the Buckley well and what the results that we'll be looking for.
So this Pittman B well is a gas well. The Buckley's going to be an oil well, but similar situations on both of them. This had a casing leak. So we went in, we pulled tubing, went back in with tubing and set a packer. and squeeze cement into the hole in the casing. So that's here on the Pittman. It's the same situation on the Buckley, just got a hole in the casing. We'll go in, squeeze the hole in the casing, come back out. The zone we're currently in will produce about 20 barrels a day in the Buckley. There's an additional zone that we'll be adding that's a little uphole that they had squeezed off a couple years ago, and we'll be recompleting that zone, and we're expecting about 30 barrels a day out of that. So 50 barrels total. Shouldn't be too big of a job. We'll, like I said, just squeeze it out, drill it out, and then recomplete it.
So on this one, what we're doing, or what we just did, is we cemented the leak. We identified the leak. Once we identify it, we squeezed it with 200 sacks of cement, right, Justin?
That's right.
Now what we're doing is yesterday we pressured up on the well. So was it 500 PSI?
Tested to 500 PSI, everything looked good. We're just doing a secondary test right now. We're swabbing the well down, making sure we don't have any additional water coming into the well bore.
Yeah, so we're just doing kind of like a fail-safe, making sure that when we test the well out that it did test positive yesterday, which is what we wanted. So we're just performing a secondary test just to confirm our initial test. Once we do that, then we will drill through the cement in the bottom of the well, take the well back to sales, right?
That's it. We'll drill it out, go back in, set a packer, bring the swab rig back out here and test it, and everything looks like it should. We'll put it back to sales.
There's multiple reasons we're doing this. When you're producing a well, the water that comes into the well bore as well has to be disposed of, and you have to pay for disposing of the water. By squeezing off water that's entering the well from other places outside of the formation, that causes your expenses to go up, but it also chokes your production down. So there's multiple different reasons why we're performing this job. This well can still produce without the cement job, so can the Buckley, but to produce it mechanically sound, we're going to squeeze off the water to also lower our operational costs, which will increase our production. Thanks, Justin.
That's right. Thank you.